Let's talk to John Eade. He's the president of Argus Research. Very good morning from London to you, John.
Thank you, Nick. Thanks for having me on the show today.
Well, interesting times. We've interviewed you over the last year and everything's been calm. We've got to talk about inflation, interest rates, the VIX index, market volatility. What's going on in the US of A?
Well, Nick, we have had a couple of big surges this year. You know, the first was in stock prices themselves, maybe moved up a little faster than we thought they were going to. And then the second was a surge in our 10-year interest rate.
Yep.
Up about 40 basis points. So I think people woke up one morning and said, oh my goodness, interest rates are higher. That means stocks probably should be going a little bit lower. And they corrected those equity market valuations. I think we're settling down here, maybe a few more days. And I think the fundamentals are intact to resume the bull run once we settle down.
Okay, so we had a new governor at the Federal Reserve. First day, I think the Dow was down 1,000 points. Is there a little bit of uncertainty about the new banker, or is this purely about interest rates, the yield curve on 10-year money ticking up towards 3%, and the number of basically rate hikes we're going to have potentially in the USA, and depending on who you talk to, that could be up to the number 4.
Right. So yes, a lot of that does affect the new Fed chairman, but I wouldn't say that 1,000-point drop was just because he took over in the hot seat. All indications are he will be measured like Chairman Yellen and, base his decisions on the data like she did. However, we've had a couple of data points that have come in, a little hotter than cool. Right? We saw a pickup in wages in the latest non-farm payrolls report. And although the GDP report for the fourth quarter was less than 3% in the third quarter, very strong consumer spending, export growth, even government spending. So the economy is doing very well. And I don't think it's 2 rate hikes this year. I don't think it's 4 either. But I think 3 is going to be the number.
Okay. So in terms of corporate earnings, generally, are you happy with this season?
Yes, a lot of tailwinds for earnings. Got good global economic growth. So we're seeing top line growth of 5 to 8%. We've got a lower dollar. So that's boosting revenue growth even more. And then we've got tax rates that are coming down. So, I think estimates for 2018 earnings are going to show a 20% increase,
wow,
which is remarkable this late in an economic expansion.
Okay, so in terms of the late point of the economic expansion, we've had a lot of commentators say we are in the 9th innings in terms of the cycle. But there are some people saying it's different this time. We're in the first innings. What's your take on that?
Well, I wouldn't say we're in the first inning, right? And I would say we're probably closer to the end of the cycle than the beginning. But, we've modeled out into 2020. And although we're going to look for GDP growth to settle around 2% by that time, we're not seeing a recession with unemployment claims low, with housing starts, still solid, with a steep yield curve. All of those metrics are saying decent economic growth ahead.
Okay, so the million-dollar question to wrap up, okay? Equity markets higher or lower this time at Christmas?
Oh, I think they're going to be higher, Nick. We've got a target for the S&P 500 of 3,000. So, that's about another 300 points from where we are. I think if interest rates drift higher instead of shoot higher and corporate earnings continue to grow, I think the market's in good shape.
John, thank you very much indeed for your time.
Thank you, Nick.